I have summarized today's April 21st BCAP market check into the following 11 observations, starting with commodities, which are not currently supporting the argument that a pickup in activity is in the cards. Besides perhaps a recent small recovery in nickel, zinc, and natural gas. For your information, oil, copper, aluminum, nickel, and zinc, and lumber all troughed between December 08 and March 09. The chart on the screen shows that it's possible for the S&P 500 to perform well despite declining commodity prices. However, every crisis-related equity recoveries began at or after a rebound in commodity prices. Leading economic indicators are rapidly declining from top decile levels, historically speaking, as consumer and corporate confidence is eroding despite fiscal largesse. This ties directly into spending behaviors. Current estimates for the second quarter consumption point to a 6% quarter-over-quarter unannualized contraction, to be followed by a progressive recovery. 2020 GDP forecasts keep being revised lower. Probability of a recession for most economies is 100%, while the rebound in 2021 is being revised stronger. Economic activity forecasted for that year is expected to be lower versus 2019. EPS estimates are also being revised lower, now calling for a yearly decline of 12% for this year, followed by a 25% recovery next year, which would leave 2021 EPS estimates about 10% above 2019 actual level. There is potential for that anticipated rebound to be tamed down. Dividend futures for the following 5 years have somewhat recovered after being slashed by 35 to 45% during March. But their advance has stalled since about 2 weeks now, leaving them about 30% lower year to date. So far this year, 36 US listed stocks with a market cap above $1 billion have canceled their dividend, 17 of which are S&P 500 constituents, such as Boeing, Estee Lauder, and TGX. This leaves S&P 500 valuations at fairly rich levels on forward price earning, even for 2021, which bakes in a recovery, and more so on EV/EBITDA metrics, even when equal weighted, as can be seen in the chart on the screen. Currently, S&P 500 equal weighted next 12-month EV/EBITDA stands at 11.7 times. That's about 1.5 times above 2007 highs. Both nominal and real interest rates, as can be seen here, the blue line here depicting the real 10-year US sovereign yield, being exceptionally low. One could argue that earnings and dividend yield premia are supportive of equities. Current levels on that front look more favorable compared to PE and EV/EBITDA ratios. However, there is no clear bullish signal. An important development would be for real interest rates to sustainably track lower. Leverage has been on a steady increase over those past 5 years, and current corporate bonds and loans issuance has actually picked up sizably since mid-March, pushing those metrics higher. S&P 500 net debt has actually more than doubled versus 2016 highs. Here on the screen, commercial and industrial loans showing on the log scale since 1985, of late clearly breaking resistance on the upside. We are witnessing a tsunami of credit downgrades. Here showing S&P credit downgrades. These are the red bars here in the chart. Very few upgrades, and that thin blue line represents the ratio between upgrades and downgrades. As you can see, it has been collapsing quite a bit of late. Now, in the first quarter 2020, 613 downgrades at S&P. That's the most we've seen for any quarter since 2010. And Q2 is set to more than double that figure at current pace, considering that we have data only up till April 20th. Corporate spreads have generally retraced about 50% of their previous widening, thanks to a proactive Federal Reserve and follow-throughs by other central banks. It seems as if the early April bazooka announcement was a sell the news opportunity, as spreads have resumed widening a little bit over the last 10 days or so, sending both investment grade and high yield prices down, despite the fact that sovereign yields are actually lower in that time frame. Equity prices have held up pretty nicely for the past 2 weeks in the face of changing conditions for three market determinants. The first one is a strengthening US dollar of late. That's the green line shown on an inverted scale here. Two, lower commodity prices. Here showing my WTI producer price index, and then copper prices. And the third one, well, what about 10-year US Treasury yields? Retracing out of their most recent increase and actually hitting recent lows. I have not mentioned once COVID-19, yet I feel obliged to do so, as it has precipitated countries into social lockdowns and economic slowdowns. This will be addressed in a separate video, but in a nutshell, I don't think this quote-unquote concern can easily be put aside. There have been several misleading information so far on that topic, and I expect there will be more to come. My position is one of caution.